Go through 1 through 5 from the largest trade partner down to number 5. So we'll start with Canada and move on down. But this is really I want to just lay out the context as this is really a pretty significant deal in that there's a lot of money at stake, but this is also our 5 largest partners, and make sure that we don't lose sight of that. So this is a really busy slide, but what I want to point out here first off is draw your attention to the darker red line. This is the one that matters. What I want to do, again, painting the picture before we dive into the 5 different countries and what's happening with retaliatory tariffs, is just to help you understand that this is all agricultural exports from the U.S. to all partners across the world, all markets. There's that midline at 0, right? And you can look back a few years, year-over-year change. So in 2015, you're seeing that agricultural exports fell about 5-6% versus 2014, and so on. So in 2018, we actually rose about our total ag exports rose at about 2%. So again, just some context for some industries that have been hurting really, really badly. In total, we have not the ship is still upright and we're still moving forward. Same thing again, the only data we have for 2019 is January, February. We're still catching up on data because of the government shutdown, but we're actually above water in 2019 as well. So there's a few commodities that you see that are actually keeping us above water, and that's wheat in 2019, and corn is doing fairly well, and tree nuts, strangely enough. But the rest of them, pretty much, you can see that downward trend that things are not going well for most commodities as we start out 2019. Year over year, for the same period, things are getting tougher. So it's not a pretty chart, even though the total would tell you that things are fairly okay. So let's start with Canada. So across the 5 countries that we're working with, talking about trade, there is a vast difference in not only the discussions, the points of contention, what's at stake, all those things. And our earlier speakers covered that very well. And it's also very different in what's been put up on the list of tariffs, of what's being disputed or what's being charged. So in Canada, they took kind of a soft pedal, right? There are more commodities that are on here, but they're relatively small, and I didn't want to put all of them on. But this gives you a pretty good understanding that Canada was not going to go after the big agricultural commodities that we export to them. They soft pedaled. A 25% tariff is pretty large, but really, if you look at it, they're going after orange juice, which if you're an operator if you're a citrus farmer or a bottling plant or something down there in Florida, you're unhappy and you are being hurt. But other than that, it looks like they're going after dairy ingredients. So yogurt, cheese, chocolate, those types of things. So relatively minor unless you are in one of those categories that's being hit specifically. One of the things that they've been talking about in the last few weeks, Canada has talked about maybe resurrecting the list and adjusting the list, maybe throwing on a lot more agricultural commodities that may hurt more, simply to fine-tune the $15 billion so that they are dollar for dollar. And so they've come out and talked about that. We haven't seen a list yet. It would be 45 days after that list before they would actually enact it or have the potential to enact it. But they would be discussing what would hurt the U.S. most and hurt the Canadian consumers the least. And so there's still room for additional pain there. So China is the number 2 market for us right now, but probably not for very long. I actually saw an article yesterday talking about how just through the first couple months of the year that China is now, I think, our 5th or 6th trading partner. The USDA is actually expecting China to fall from number 2 to number 5 by the end of this year. So over 90% of our ag commodities that are going to China are now tariffed, some worse than others. But as you can see from this chart, whether you can see the names of them or not, it's basically across the board. You have ethanol and tree nuts that did fairly well in 2018 versus 2017. But now pretty much everything else in at least the first couple months of the year, everything is significantly down from where it was last year. So, and this is not just a few crops, and it's not just consumer goods. These are very fundamental ag goods that are being hurt significantly. Number 3, Mexico. Again, some mixed impacts here. They've really put tariffs on, specifically on hams, on cheese, and on apples, and there's a couple others as well. But again, just a mix here, right? So pork was down in 2018 marginally. They're down a little bit more early this year. Dairy as a whole is up both last year and the first part of this year. And if you look at the specific HTS codes, they're kind of all over the place. Some of the cheeses are up, some are down. Milk powder, I think, is down. It just depends on what your product is, so it isn't uniform. Apples fared fairly well in 2018, but they're really taking a hit here in 2019. So geographically across different industries, it really depends on where you are, whether you're winning or losing, and by how much. On to the fourth one, Japan. So we talked about this a little bit earlier this morning as well. So this is kind of an interesting situation because it's not just, we talk about TPP, but it's not just TPP, especially for agriculture. It's about TPP as well as the free trade agreement that was formed with the European Union. And so if you throw in TPP along with the EU, you have an awful lot of competitors that are about to sit in a much, much better position going forward. And with each passing few months, they'll actually be in a better position than they are right now because tariffs will continue to go down. We've already seen those lines may be too small to see, but the biggest immediate impact is on beef and pork. We are now basically being squeezed out of the Japanese market in those two products because those tariffs have come down for the TPP partners as well as for, and Europe is on the way down as well. So plenty of pork, plenty of beef, plenty of dairy, plenty of wheat, all those things, vegetables, fruit, across those different partners. There's plenty for them to sell while our prices are considerably higher and there's not much we can do about it. So that's the urgency right now is there's momentum building with Abe and Trump to try and get something done. There are literally billions of dollars at stake just for a few commodities. So back to the EU. So again, very selective in what they have put on the list to put tariffs on. And so we're talking about rice, cranberries, peanut butter, kidney beans. There was an article a few months ago about kidney beans that are being sold to the EU from a company in Wisconsin and the ins and outs and the pain that they're experiencing. Those are, again, very, very microcosmic type of pain on a few different commodities, but you won't see them in the big numbers. Definitely angled at a specific region to hurt specific politicians or hurt voting in the next election, whatever that intention is. But now the EU and the U.S. are left to try to hammer out their next deal. And last summer we had Trump and Juncker meet to talk about that. It was made very clear that the EU was not going to open up to agriculture. And now here we are 8-10 months later, and there seems to be a misunderstanding or, to put it nicely, I guess, that we just did not interpret or forgot or whatever that agriculture was off the table. And so now we're upset about that and talking about tariffs on autos again. So it'll be interesting to see what is used, what tactics are used with Japan and with the EU to try to get agriculture back on the table to discuss. So, but here's the other thing that's going on. While we're still wrestling with China and USMCA and everything takes time with trade, as we know, the EU has been very offensive and very much on the offense and has formed free trade agreements with Mexico and Japan and Canada a little while ago. And they're going to continue to look for more opportunities. They believe in globalization and they believe that they can step in. They now have an opportunity to fill the gap that we have left. And so there will be more competition to come in the years ahead. And so those are kind of the direct impacts that we see right now. There's a lot of things that we're worried about more in the medium term to long term. And some of those are supply chains that are being built now that are set up around these new free trade agreements, as well as just going around the United States and putting up Plan Bs and Plan Cs, given that the U.S. has become pretty inconsistent. So those are the things that we think about is what will supply chains look like, and will they be reversible back to what they were to support us over the last several years. We are incentivizing production in South America and the Black Sea. We have been for a while, but this, some of it's about currency, some of it just has to do with the strong U.S. economy and geopolitical things happening in Brazil and elsewhere. But the reality is that as long as we are disrupting markets and really as we've encouraged China in one way or another to put a tariff on some of our products, there's now all the incentive in the world to continue to expand soybean acres in Brazil out into the Cerrado and do more than what they've done in the past. And so I foresee that happening for the next several years. I don't see that stopping. There's still plenty of land to be converted. And the same is the case in the Black Sea. So if you go to Russia, Romania, Ukraine, there's still land to come into production, but there's also land that will be converted from wheat into corn into soybeans that we haven't had before. And so as we try and claw our way out of a pretty steep fall into supply and demand struggles here in the U.S. and around the world, there's still a lot more that can be done to pile onto that, which is our greatest concern if things get worse. So really we see trade in kind of the direct impacts, but also the indirect that are kind of the longer term as we think of the health of the agricultural economy here in the U.S. and the ability to compete. The playing board just got a little bit more competitive for all the characters that are going to take bigger positions. The last thing I'll remark about is African swine fever. Most of you probably know this is just ravaging the pork supply in China. And this, for all the terrible things that's happening for them, this has a potential to be a really good thing for us. Prices have already come up significantly here in the U.S. on pork prices and on hogs. So that's great for us as long as that virus does not end up coming here, right? So that would be lights out. If it happens to show up here, then we lose all of our export markets and we have a whole lot of pork that just has nowhere to go. So